So, welcome to those who just join us. It's now time to launch the second EnergyScan webinar session of 2023. I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management and Sales. So first, I would like to focus briefly on the 2023 energy risk commodity rankings. NG Global Markets has been listed in 5 research categories. And we have been notably ranked number 1 for natural gas research, number 2 for power research, and number 3 for emissions research. These are outstanding results, and we would like to thank you warmly for your trust and your votes, which are really key for us in order to continuously improve our services. So moving on to today's webinar session. So 2023 started with a significant drop in wholesale energy prices, which now sit on a high plateau in Europe and in Asia, reflecting a global loosening of the energy supply demand balance. So in this session, we'll try to figure out what the potential risk to move out this equilibrium are, with our speakers, namely Olivier Gasnier, Évariste Nouki, and Étienne Covin. As usual, we'll start with Olivier on macroeconomics and crude oil trends before switching to natural gas with Évariste, and conclude with European power and carbon markets with Etienne. Let me remind you that this is an interactive session, so don't hesitate to use the chat module to ask questions to our experts. We'll do a Q&A session at the end of each presentation. So finally, you will be asked to fill a 30-second satisfaction survey at the end of the session. And the slides and the replay of the webinar session will be available by tomorrow at the latest on our EnergyScan platform. So Olivier, the floor is yours now.
Thank you, Julien, and good morning to everyone. We'll start this presentation with the end of central bank rate hikes, or probably we are close to the end. While commodity markets have regained some calm, the macroeconomic and financial environment has not, clearly. And by way of introduction to these slides, we can start from this fact that the strongest tightening of monetary policies in the last 40 years is now close to ending. And this is linked, in my view, to 3 factors that we'll come back to. Disinflation first, the recent troubles that affected some banks. I hesitate to use the word crisis because if there was one, it was very quickly contained by central banks. And finally, the risk of recession to begin with the US. The chart on the right shows that markets believe that the remaining upside potential is greater in Europe than in the US, which is clearly narrowing the 2-year spread, interest rate spread. This is on the chart on the left now, and which is pushing the euro-dollar exchange rate higher towards 110 at the moment. So first, disinflation. We can see from the graph on this slide that it is very clear in the US, disinflation, and in the Eurozone, and it's largely explained by the fall in energy prices and the base effect resulting from the fact that we are now comparing current prices with the very high prices that followed the outbreak of the war in Ukraine. Energy prices, if you take energy prices alone, they account for 4 percentage points of the fall in inflation rates. So this is more than what was observed at the general level. So that means that other prices have continued to accelerate, and in particular the prices of services and food in the euro area. It can thus be seen that core inflation rate which excludes the most volatile components, so energy on inflation, precisely on the food precisely. So core inflation rates are not falling or even continuing to rise, and that leads central banks to want to continue raising their key rates. Now the banking crisis. Uh, of course, here we don't have time this morning to go into detail about what happened last month. What we can see is that the collapse of the Silicon Valley Bank and then the fall of Credit Suisse in Europe did not degenerate into a major banking and financial crisis because the central banks, of course, have learned their lesson from what happened in 2008, and so quickly they provided the banks with unlimited access to liquidity. Um, should we consider that this episode is over now, or that it will leave traces? I lean towards the second answer. First observation that you can see on the graph on the left, the flight of deposits was really substantial and did not only affect small institutions. The second observation is that the crisis has revealed the fragility of banks, which are still really neglected by the stock market. It has also led to an increase in the financing conditions of all the riskiest economic actors on financial markets that can be seen with the widening of spreads for junk bonds, for example. Moreover, if we come back to central banks, we can see that despite the rise of the last few days, rate expectations have been clearly revised downwards, especially in the US. The idea is that the crisis is going to do some of the work of the central banks because faced with higher funding costs and tighter regulatory oversight, the banks are going to tighten credit conditions further. And I say further on purpose because it was already the case before the crisis. Uh, Central banks they must also realize that the rise in interest rates has already had an effect, especially in the United States. And that is exactly what was reported yesterday evening by the Fed's Beige Book. The Beige Book clearly said that there was an impact on credit condition from this crisis. If you look at the leading indicators, they really point to a recession, starting with the yield curve, that is to say, the difference between long and short-term rates. Normally, you have a positive difference. This is a normal configuration because the price of risk, of course, increases with time. The inversion of the curve has been very strong for a while now, and it is starting to narrow, especially for the difference between the 10-year and the 2-year rates. And that seems to indicate, if you refer to what happened in the previous recession, that a recession is coming before mid 2024 at the latest. The same is true of the conference board's leading indicator. Here you have the change, cumulative change over 24 months, and you can see that it's really a very, very reliable leading indicator of recession. And that tells you that this recession could come before the end of the year. So tighter time frame compared to a yield curve. And finally, we should keep an eye on the manufacturing ISM index, which fell to 46.3 in March. And you can note and can see very clearly on the graph that's below 45. So very close. The US economy has always been in recession. What about the Eurozone and China? For the Eurozone, the winter went better than expected thanks to the decline in energy prices and gas prices in particular. Recession was avoided, but it seems that confidence and business sentiment have plateaued since the beginning of the year and even declined in industry. And that was confirmed, for example, by the INSEE survey in France this morning. There is also a clear reversal of the trend in credit, both for business, which is shown in the middle chart, showing monthly changes in billions of euros, and for households as well. What is represented on the right-hand chart is the credit impulse. What is credit impulse? It gives you the dynamic of credit, its acceleration, its slowdown. And so you can see that the slowdown is rather brutal, as it was before the banking crisis. Obviously, this will have an impact on economic growth. Now, China. GDP growth picked up sharply in Q1, as you know. The figures were released on Tuesday, with an acceleration from 2.9% year on year to 4.5% year on year for the Chinese GDP. This was expected after the lifting of sanitary measures that boosted the consumption. However, it's important to keep in mind that the base effect is extremely favorable. And this will be even more the case in April and May, as part of China was facing a strong resurgence of the pandemic a year ago. If you remember, Shanghai was under a very strict lockdown in April and May 2022. If you look at the consumption of goods, retail sales here, they have declined in March 2022 and were not very dynamic still in March 23. So consumption of services have recovered more, but it doesn't have the same ability to drive the global economy, of course. The second positive factor to explain the Chinese recovery is the rebound in the housing market, which we see through the halt in the decline in prices on the right-hand chart. You can see that for the last 2 months, there has been a rebound in prices, and a strong rebound in bank lending on the middle chart. The question, of course, on everyone's mind today, whether this rebound can last, as the crisis seems to be deep with huge unsold inventories and property developers in serious financial difficulty. It seems a bit strange that all this has been solved in such a short period of time. So, global GDP growth forecast. As you can see, we expect a recession in the US and Europe in 24. In fact, it could start as early as this year in the US, as I suggested previously. But the timing, of course, is always tricky to find. If the economic slowdown does not materialize soon, you can think that central banks will probably have to keep raising interest rates, which will only increase the likelihood of a recession later on. Growth in China is expected to be strong this year, less so next year. The main message is that overall, 24 would be worse than 23, not better, as is the consensus today. So if you have any question on the macro side, I will answer them in a few months, but let's move on to the oil market. Now, first of all, we can see that with rare exceptions, the price of barrel of Brent crude oil has remained in a very narrow range, from 80 to $87 per barrel since December, since the EU on G7 sanctions against Russia began late last year. Sorry. So you can see on this chart that OPEC has twice announced significant production cuts. The first was mainly to bring targets more in line with actual production levels that was decided in October last year, as well as to show that OPEC was keeping control on the market despite the sanctions against Russia, notably the price cap. Recently, OPEC intervened to prevent a drop in demand following the banking crisis and to raise prices. So there is clearly a desire not to let prices fall too low from OPEC. This is really obvious. On the supply side, there is little to expect from the US, which will only be able to increase production to a limited extent. For example, if you look at the evolution since the start of the year, the US oil output has only increased by 100k barrel per day, which is very, very, very small. On the Russian side, production is supposed to be reduced by 500,000 barrels per day until the end of the year. But the reference point is uncertain. For example, OPEC mentioned the fact that it could be the level of February. But if you look at the actual evolution of the Russian output, the fall was already supposed to take place in March, and the various estimates do not confirm such a reduction. And if you look at exports, they have even reached a record level in March. And over the last 12 months, for example, they have increased by more than 2 million barrels per day to India. So for now, no reduction in flows from Russia. For the OPEC country covered by the OPEC Plus agreement, that is to say excluding Iran, Venezuela, and Libya, the latest cut only concerns 6 countries, and they would indeed result in production cuts. But it's certain that if Russia does not cut its own output, as promised, tensions will likely arise, and some OPEC countries will refuse to make further efforts. And we think about the United Arab Emirates, for example, or Iraq, that have both expressed, criticism about the OPEC policy in the past. Now, demand. In terms of demand, the pattern is fairly simple and linked to the macroeconomic situation. You have a downward revision for OECD countries. You can see here on the left-hand chart the forecast from the various agencies. There is the reference to the EIA forecast lacking on the graph. But in parallel, of course, there is an upward revision for other countries with a confirmed rebound in Chinese demand in recent months. So you can see the trend in the middle chart of imports of crude oil. The Chinese demand has been also supported by the increase in export quotas for refined products, of course, with more need for crude. It should be noted, however, and this is the right-hand chart, that this probably that explains also the OPEC's recent decision that the high level of stocks in the OECD countries could potentially weigh negatively on demand in the coming months. So now the balance between supply and demand. After OPEC's decision, the market, which was oversupplied in the first quarter, you can see the plus 0.9 million barrels for stocks on the penultimate row of the table. This oversupply would switch to a deficit until the end of the year, but it would be difficult for OPEC to repeat its intervention. I explained already the fact that there are already some tensions between OPEC members if a recession actually occurred in the US, for example. So we can assume that prices would still fall nevertheless, even if the market is tight, and what happens right now seems to confirm that, with nevertheless fundamental support of this market in still tense, preventing a too sharp a fall in prices for oil. So thank you for your attention. Do we have any questions, Julien, about macro or oil?
Yes, Olivier, thank you for your presentation. Yeah, I will start with one question regarding I would say the global feeling that the economic outlook is particularly uncertain. We hear that central bankers are arguing for very different scenarios on whether or not to continue to fight inflation. So you are predicting a recession, but if it doesn't materialize, what happens?
Well, I evoked that very shortly already. I think we risk having a scenario that could be similar again to the early 80s. This reference to the early 80s has been a constant since the inflation slippage last year. So we can imagine a scenario in which the economy does slow down, but not enough to break the inflationary momentum. In this case, it's very likely, given the tensions on core prices, that inflation would rise again and that central banks would have to start a second round of monetary tightening. And that was exactly what happened in the US 40 years ago. And that had at that time very painful consequences. And in the current case, we can also imagine that it would have more destructive effects, but later.
We have a question in the chat. So, do you see indications that liquidity will dry up, and if so, which?
Yeah, very clearly. But even before the crisis, the growth rate of monetary aggregate had already started to slow down sharply, and this is linked to, in particular, to the fact that the Fed had engaged in a process of quantitative tightening. That is to say, trying to bring back liquidity in the central bank. All this liquidity that has flowed since the great financial crisis more than 10 years ago. So yes, and but the problem is that that came just before an enormous amount of liquidity on the market, freed on the market during the COVID crisis. And so, for the time being, it was only the beginning of a dry up of liquidity on market. But we can think that yes, it has contributed to this tightening in credit conditions. Yes.
So we'll take one last question from the chat. So can you just repeat on what year do you expect the economy to exit the potential recession or stagflation scenarios?
What year do you expect the economy to exit the potential recession or stagflation scenario? Well, as I showed, I think 24 will be worse than 23 because I think that it's these are average numbers that even if you have a deterioration, a recession starting in the US this year, the impact on the average numbers will be more felt in 24. I think, I mean, if you have a recession starting in 23, that is not necessarily a very strong recession because several factors, the fact that the housing market is not as imbalanced as it was the case at the end of the year 2000. The indebtedness of households is much, much lower, for example, these kind of things. You in this scenario takes place, you can imagine that in the course of 2024 there will be a recovery. For Europe, I think if the recession comes, it could come a bit later, probably. On that could mean that 24 is bad, and you can expect better time in 25.
Okay, thank you, Olivier. It's time to move back to our presentation and switch to the natural gas outlook with Évariste. Hello, Évariste. So the
Hello,
floor is yours.
hello everybody. So let's start on the natural gas outlook. In recent weeks, several European officials have insisted on the need to maintain the demand reduction efforts to avoid the gas shortage for next winter. Obviously, this is a view we share because we already highlighted it in our previous webinar in January. So the two tables here are already the one we showed previously. Just to insist on the fact that If you start with the current level, that of 2022, it will be difficult for the European gas balance to be comfortable if you add another layer of demand. It's not possible just for LNG supply to offset the strong decline in Russian gas volumes. So you can see it clearly on the table, starting with the demand value of 2022. What we can do now is just move on the left-hand part of the table, so heading towards a demand around 380. You cannot afford going on the right-hand star. So the good news is that since the end of 2022, of course, the scenarios are on the positive side in terms of demand for sure. Yes, we continue to lose Russian flows, as you can see it, if you compare it to the value of 2022. But if you look at industrial demand, we are significantly down. We are talking about a drop of around 15%. The same for local distributions on demand, mainly residential, commercial, and small industry. And even on gas to power, we are seeing a drop. This was not the case in 2022. This is the positive news for this year, but this doesn't mean that everything is fine, just because there is a risk, and the risk factor is clearly on this gas demand for power generation. When you look at the trend, the recent trend in power prices, you see that because of the strikes in France, EDF has lost weeks of maintenance on several reactors. And if you add the corrosion issues, this has raised some concerns about nuclear availability for the coming winter in France. And this pushed French power prices significantly up. You can see it clearly on the graph on the right. Fortunately for buyers, this surge in French power prices had not totally spread to all the European power prices and not to gas prices. Why? I will say thanks mainly to the German market. And when you look at carefully the graph on the right, you can see it. You see that German prices, the orange line, are almost sticking, in fact, to the clean gas cost. Meaning that in Germany, people believe that you don't have to pay a lot gas power plants to run. You don't need them, even if the French market is tight, even if probably France will need neighboring countries, including Germany, to export to France. The German market probably could fulfill this role, not with gas, but mainly with renewables. And to see it, you have to reverse to the graph on the left. Here we show the trend in renewable generation, mainly wind and solar, versus gas and coal. You clearly see the negative correlation between the two. Of course, on the day you have a strong renewable generation, you don't need thermal generation, you don't need gas and coal. So even if now, as you know, Germany has closed its last nuclear power plant, so you have lower nuclear, almost zero nuclear. Even if you have to export to France, the market seems to believe that at least very often, with the help of renewables, you can make it produce enough power to produce for Germany and also to export to France. Of course, there is a risk factor to this view. We are focusing on wind and solar, but you can think about hydro as well. You can think about an additional drop in nuclear generation in France. So there are a lot of risk factors, and for me, the power generation sector is clearly the main risk factor for the gas market. If demand is weak, as is the case since the start of the year, You can continue to have a downward pressure on the gas market thanks to lower gas demand for power generation. If it is not the case, if you need to produce more power with gas power plants, you can have some problems on the gas balance. That's why we ask the question, finally, can we be afraid about the impact of French nuclear problems that could finally provide bullish momentum to gas prices? Here you have the trend in gas prices on the two benchmark, on the TTF. On the left, you have day-ahead and month-side prices. On the right, you have the calendar contract, Cal 2024. Recently, and you can see it when you focus on the values for April, at the beginning of April, prices increased quite significantly above the 20-day average. For us, as a reminder, this is the early signal of a trend reversal. But you can see that on the day ahead and the month ahead, the 20-day high, which is roughly the average plus a certain level of volatility, this 20-day high managed to block the increase. It was not the case on the graph on the right, on the calendar contract. It did not manage to block the increase, at least temporarily, but prices dropped afterwards. And then you see clearly that day ahead and month ahead prices continue to weaken, and now they are clearly encore below their 20-day average, confirming their bearish bias, which was not the case on the calendar contract, at least until yesterday. Yesterday, prices continued to drop on the Cal 24 contract. They closed slightly above the 20-day average, but this morning it seems they are dropping below. For buyers, this is a good news. It means that there is no acceleration in the rise of the calendar contract, and even this calendar contract is losing now its bullish bias. For us, this confirms our bearish scenario, the one that we built in January, and you see that since then prices are clearly on the positive direction for buyers. You can look at the scenarios both on the month side on the left and the year ahead on the right. You see first indication that prices seems to have a floor around the coal prices and also oil prices. Oil prices, of course, are now less important for our European gas market because we don't have now a lot of oil index contract. But in Asia, this is still relevant. This tend to set a floor to Asian prices, to GKM prices. So prices are in a kind of equilibrium around coal prices and oil prices, and well inside the coal switching range. We believe that month-side prices could continue gradually to follow this range. This range could continue to drop. This is what we estimate to be the one-year low, but it's not sure again. It will depend on coal prices and oil prices as well. But overall, we expect the prices throughout the end of the year to continue to trade between their one-year low and their one-year average. This is for the month ahead, with a certain volatility, of course. You have the same on the graph on the right with the calendar contract, trading between the one-year low and the one-year average. What can be difficult to monitor and to handle for buyers is the volatility, of course. As you can see it on the graph on the left, the range is rather wide for the moment. What does it mean? It just means that as long as stocks are not full, you can still have an upside. Because in case you have a bullish factor, of course, people would be in a hurry to try to fill their stocks. As a reminder, the target for the European Union is for stocks to be full at 90% by 1st of November. As long as stocks are not full, you can have a high volatility in the market. This is the way you can understand the range, particularly on the months ahead contract. But as soon as stocks are full, let us say around September or almost full, it means that you will no longer have this pressure to fill your stocks. You will not be in a hurry to buy gas, whatever the cost. And at that time, you can have a lower range, meaning a lower spread between the 1-year average and the 1-year low and the 1-year average by the end of the year. So this is the way you can understand the messages. So higher volatility in the very short term, and gradually lower volatility when we approach the period stocks are almost full. So that's it for me, Julien. I don't know if you have some questions.
Yes, thank you, Évariste, for this presentation. Yeah, we have several questions in the chat room. So I will try to. I will start with the first one. So first question. So can we say that current gas prices are indexed in the LNG cost, and accordingly, as long as we will receive important LNG volumes compensating the cut in Russian pipeline gas deliveries, will the price remain on a floor around 30 to 35 euros per megawatt hour? So I think we are talking about the TTF front months, let's say.
In fact, a lot of questions in one question. So first, I don't know exactly what is the meaning of the LNG cost. Maybe you can think about the flexible LNG in the Asian market. As I mentioned, in Europe, we don't have a lot of oil index prices now. In Asia, it is still the case. Let's take the case of China, for instance. China is buying LNG mainly from with long-term contracts indexed on oil. You can imagine that the price is close to, yes, not far from the Brent price. So that's why I think about the graph I show about the Brent. We set a kind of floor for gas prices. If gas prices drop below that level, you can imagine that in Asia, you'll have some buyers, like Chinese buyers, having an incentive to go to the spot because the spot will be below their long-term contract. And if it is the case, you will see China, whose LNG imports are strongly down. They were strongly down in 2022. They are also down this year. But if the spot price drop below their oil index contract price, LNG index contract price, they will go to the spot market and probably tend to push the prices up. So the floor, you can understand it like that. So I'm not sure that floor is around 30 or 35 because yes, the floor is not fixed because as we said, the floor is depending on coal prices and oil prices. So if oil prices weaken, yes, you can have a gradual drop in the floor. But of course, if you have a rebound in oil prices, you will also have a rebound in that floor price.
Okay, we have a second question on the LNG market. So what is your assumption in terms of LNG availability for the rest of the year? Will Asia compete to attract LNG, or will it be reselling cargoes on the spot market?
So I partly explain, give an answer talking about China. Let's start with the global availability. In fact, this year, yes, we have an increase in total supply, but not so much. So for Europe, the additional LNG we can have will not come from an additional strong increase in supply, but mainly from demand destruction in Asia. So Asia should continue to limit its energy import. As I said, it is the case for China, for instance, because they have alternatives. They can move to coal. Economic rebound is there, but not as strong as expected. Not enough to push LNG demand strongly up. And in Japan, we are seeing a drop. So we are talking about the two biggest LNG importers, Japan and China. So as long as those two countries are not on the spot market, Europe should continue to benefit from strong LNG supply.
Okay. One last question. We talked a lot about LNG supply. Just one question regarding demand. So you mentioned that demand destruction was a key factor to balance the European gas market. So what is your view on LDZ, so residential heating demand destruction for the coming winter? Will it continue to be lower than what we have seen over the past few years?
In fact, it's now very difficult to give some assumptions on LDZ demand, regional commercial mainly, because you have the combination of two effects. So for the last last winter, you have the combination of milder weather and at the same time you have the effort to reduce demand. So for us as analysts, it is difficult to see exactly what is the main driver. But now what is sure is that I believe that demand destruction is now here to last. Even for next year and the years to come, people know that probably we are heading toward a world where you have to save energy, so you have to do some effort to reduce consumption, and as well you have this sensitivity to the price. In fact, so switching to other energy sources is also something you have to monitor very carefully. And to link it to what I said previously, you have to look at the trend in oil prices and the trend in coal prices. For sure, in Europe, we will not ask people to switch to coal heating, which is the case, by the way, in Asia, in China. You have district heating with coal as well. In Europe, no, but you can imagine switching to oil products for heating, even for LDZ, meaning that gas prices should continue to have the bearish pressure coming from oil prices. You have to imagine gas as a commodity within a global energy complex. And this complex, you have coal, you have oil, and probably tomorrow you'll have renewables. You cannot have a global and lasting disconnection between gas prices and those drivers.
Okay, thank you, Evariste. So it's now time to move on to the last part of the presentation, the power and carbon market outlook with Etienne Covin. Hello, Etienne. You can start now. Hello, Etienne. We don't hear you, Etienne. I don't know if you're on mute. No, we still do not hear you. No, we don't hear you. Yeah. Still no sound. Can you maybe try to unconnect your pods and try to. No, we don't hear you. Sorry for this technical issue. So sorry, we are going to wait 1 minute to find a solution. Sorry for this technical interruption. We'll try to start again.
Hi, Julien. Are you hearing me?
Hello, Etienne. Yeah, we can hear you now.
Ah, perfect.
Good.
Sorry about that.
Okay, you can go on.
So let's start. So yeah, I was as I was saying, today, as Julien said, I'm going to present you the recent evolution of carbon and power prices, and of course our outlook. But as we are at a time when the electricity market has taken again a front seat, as Evarist already told you, for once, let's start with power. And let's begin with the current state of the European power demand. So as you can see on the left chart, which represents the French electricity consumption corrected from weather effects, the energy crisis continues to curb the country's power demand. And it's also true on the neighboring country. But how can we explain that? Well, despite the recent retracement of prices, which I'm going to present you, of course, in the next slide, unfortunately, prices remain at a historically high level. So most of the energy savings measures taken last year, including, for instance, the industrial production curtailment, are maintained. And unfortunately, the outlook is not much better because when you look at the right chart, which represents the manufacturing PMIs, which is an indicator of the industrial production health, we can see that most indicators are still below 50% and actually reversed from the late 2022 recovery. So this suggests that we can expect a contraction of industrial production in the coming months. Of course, you can say that it's only one indicator and you can question absolutely its reliability on the message, but it still provides a pessimistic signal regarding the power demand recovery for the upcoming year. Moving on to the supply part of the power market, let's have a quick look first at the hydro situation. So as shown in the upper left chart, favorable weather conditions have significantly improved the hydraulic power generation over the past weeks. You can see it pretty well with the dark blue area on the chart. And it also, of course, had a positive effect on the hydraulic reserves, which are now standing in the upper end of the historical range in France, Switzerland, and Spain. But basically, the situation is less positive in the Nordics and Italy, which is not shown here. But what are the impact on the power prices? Well, it's actually pretty good news because it helped reduce them on the prompt market over the past weeks, and a continuous improvement of this situation could also reduce risk for the third quarter of 2023 in Central Western Europe. So not is all bleak at the moment, but some things are, unfortunately, especially on the nuclear power front. So I'm sure by now you have all heard there were some recent developments regarding the French nuclear situation, spurring uncertainties again on the availability we can expect for this winter. And I'm sorry to say, but not only that is true, but now two factors are actually impacting the nuclear picture. So first, and you may have seen on TV or in the streets, even for a French audience, the strikes against the pension reforms are being prolonged into April and are starting to have a significant impact on EDF's nuclear maintenance schedule. Indeed, the strike actions have further delayed the planned returns from maintenance of reactors deeper into April, with no more 200 days lost since March 17th across 1,000 reactors. So really a very strong impact on the maintenance schedule of EDF. And more recently, to give you an instance, at least 5 reactor starts were postponed, pushing the return dates of these reactors deeper into autumn and potentially impacting EDF's new accelerated repair strategy submitted mid-March. To give an idea of the damage, an article from Reuters mentioned that the strikes will cost EDF about €1 billion and that their impact could take 18 to 24 months to be absorbed. So, yeah, quite a bleak situation only on the social front. On the technical one, and as I mentioned before, it's only part of the on the technical one, there is also new news regarding the corrosion issue, because mid-March, the ISN discovered a deep crack at the Pelny 1 units on a previously twice repaired weld, but also thermal stress crack, which is another issue, at Penly 2 and Platinum 3. So the first issue represents new risk of stress corrosions on line previously considered safe by EDF, while the second one was supposed to be a well-known phenomenon closely monitored during the 10-year visit. So in my opinion, what's really triggered a wave of panic buying in the French market, and we're going to see it in the next slide with prices, is that both problems could potentially impact all reactor designs of the fleets. So I let you imagine the consequences of the country's availability and prices if all those risks materialize. But what's the actual impact of the issue on EDF's maintenance schedule? Well, first, it's actually rather good news. Closing all reactor units at risk was avoided, thanks to the ISN accepting that early leak detection would avoid large radioactive release inside the containment area. However, and this is more of the bad news, Nuclear Watchdog has requested EDF to revise its inspection strategy and prioritize 320 wells at risk on all reactors of the nuclear fleet. For the current situation, so far 69 have been identified as most sensitive to corrosion issue, and EDF aims to inspect 148 wells by the end of the year. So all in all, we are still expecting the remit update reflecting all these issues. And if the ISN approves EDF's new strategy, it would allow the utility to maintain its 300 and 330 terawatt-hour 2023 nuclear output target. You can see on the bottom table all the targets and the actual realized production of the previous year. As always, and this time I want to draw your attention on the chart, it's very important to remember that the remit availability showed by the dashed line, red and in green, does not represent what we actually expect of the nuclear production. You can see in the table, for instance, that the current remit shows 377 terawatt-hours of production, at least availability this year, while EDF maintains its target of 300 to 330 terawatt-hours. So it's much lower. So you should expect an actual correction of the remit availability. The second message is also that the availability will remain significantly weak. You can see it was already quite catastrophic last year with the light blue curve. It already started the year on definitely lower than historical average, and it should remain quite poor in the coming months. Okay, so moving to prices now. And before showing you the impact of all these news on the power forward market, because they had an impact and quite strong one, I think it's always interesting to have a quick look at the recent evolution of power spot prices so that you can have a better idea of what we can expect on the forward market. And as you can see on the left chart, the spot prices pursue their slow retracement over the past week, pressured by strong renewable production on one side, mild temperatures events throughout the month, and of course, relatively stable gas prices. But unfortunately, for the heavy consumers in the audience, a rapid return to early 2021 level is quite unlikely for now, as definitely as gas prices seems to have found a floor at 40 euros per megawatt hour. It does not mean that they can't go lower than that. It just seems like they have found some quite strong support. And of course, carbon prices, and I will talk about it in the next part of the presentation, remains 3 times now more expensive than they were 3 years ago. So all that should continue to support the current level of power prices. And now moving to the more interesting part, the power forward market. So as you could expect, the recent nuclear news had a strong impact on the French prices, and you can see it pretty clearly on the upper chart. You can see that with the blue curve, a risk premium quickly re-emerged for this winter due to all the uncertainties on the availability for the end of the year. So basically, we are back to a situation close to last year, with French prices strongly diverging for the rest of NWE and building an exaggerated premium on nuclear worries. But of course, this time it's at a much more moderate level compared to 2022. To just give you an idea, the first quarter of 2023 was priced around 1,000 euros a year ago. It's still a surprising situation, but of course it's much less risky than last year. To give you another order of magnitude, the current contract for Q1 2024 in France is nearly 250 euros per megawatt hour above its German equivalent. But the realized spot prices for the first quarter of 2023 was actually on average up by only 15 euros. So that really shows you how exaggerated the current premium on French prices is. Of course, you cannot ignore the risk from the ongoing strikes and corrosion issues, which are likely to curb the availability for next winter. But having such a spread definitely seems exaggerated. It's pretty well, and I think, in my opinion, it's highlighted pretty well in the bottom chart with the blue curve again, when you can see French prices for this winter way above the neighbors, which are closer to clean fuel costs. However, and again, unfortunately, similarly to last year, it's quite unlikely that this premium will shed in the short term, due to participants being reluctant to being short with such high risk and such, let's say, lack of clarity on the nuclear availability for the coming months. As for the other contracts, so basically German one, Belgian one, etc., they should continue to track closely the clean gas costs, but due to the limited downside potential of the gas market, Evariste already told you about it, we do not see prices going much further down in the coming months. So all in all, what will drive prices in the coming months and what you should keep an eye on are the developments on the French nuclear situation. It will remain the main focus of the market, of the markets even, because it will also impact the gas and coal one. You should also look at the long-last effect of demand destruction. And by that I mean the potential recovery of demand close to normal level. But as Evariste already answered in the question, we do not expect it to come back to, let's say, 2019 levels for now. Of course, we will have to look at the usual gas and coal competition. They are both really strongly correlated, and it will, of course, have an impact on power prices. And finally, the competition between Asia and Europe for LNG, as it might induce a rebound in gas prices if we see a rebound in Asian demand. Okay, so that's all for the power market. Let's move to carbon, and of course, I will answer all your questions at the end of the presentation. For the carbon market, let's start with the quick update of the recent evolution of carbon prices, and I want to draw your attention first on the left chart. So as you can see, with all the turmoil around the SVB failure, it really triggered a sell-off in the market. You can see with the blue curve that carbon prices dropped mid-March, and you can see in the orange curve, which represents the position of the financial players, that they really offloaded their EUAs. And actually, they adopted what we call a risk-off approach. So they sold their EUAs to move their money toward less risky assets or simply cover the losses from the financial markets. You can also see on the right, let's say, like all the charts, that carbon prices started to recover early April, and it's for two reasons. The first one, and you can see again on the orange curve, we had some renewed and definitely arguable optimism on the financial markets. So speculators started to build back their net position, but you can see that they definitely are not back to early March level. And on the other hand, you also had some support from the compliance side, because we had at the time a combination of cold temperatures and weak renewable production, which strengthened the thermal power production and subsequently the emissions. So all that pushed carbon prices back toward 100 euros per ton. But what I really want to draw your attention on is that the market is driven currently by very short-term drivers and not long-term view. And that's why we can see quite a strong volatility, a poor liquidity, but I will get over that in the last slide. And of course, a complete decorrelation from news on the fundamental sides. As for the regulation, so there were not much developments in the past week. So I only took here let's say the two main messages. So first, we had some clarity finally on the REPowerEU package. So just to keep a quick reminder, the REPowerEU is an initiative from the European Commission to raise revenues in order to accelerate the exit of the European Union from Russian fossil fuel. And part of it was the plan to raise 20 billion euros with the EU ETS. So finally, we were disclosed the volumes expected to be sold into the market, and they amount to about 40 million EUAs per year in the next 3 years, from July 2023 to August 2026. And it's actually quite lower than what we were expecting. We're expecting more around 70 million tons. So that's why we saw prices rebounded as the news. But it's still additional supply. So let's clearly remember that it actually weigh on prices, because we are expecting more a year ago. Let's say a tighter market a year ago. So it was still more clarity, but there are still some uncertainties on this aspect, because the European Commission only published the volume expected to be sold from the member state auctions, but part of the overall volume expected to be sold will come from the Innovation Fund. And at this point, we still don't know if the Commission plans to raise, let's say, the targeted revenue with the already scheduled volumes, which are at 40 million tons per year, or if it tends to front load as well innovation volumes, which would mean that they will take volume scheduled to be sold from the last part of the decade and bring it forward to the next 3 years. And the risk there is that the market is already anticipating the Commission to front load this volume. But if the Commission decided to use the already scheduled ones, it means that we will see, let's say, a weaker supply than expected, and it could push carbon prices up temporarily. The second, let's say, regulation point interesting to notice was the application of the 2022 verified emissions. So you can see on the bottom chart the evolution of the emissions per sector in the past years. And it was quite surprising to see that stationary installations, so basically all the installations accepted for the aviations, have seen overall a decrease year on year in 2022. But depending on the sector, the variations were not equivalent. So of course, on the power and heat generation side and oil and gas sectors, we saw an actually quite significant increase of emissions due to more competitive coal prices, which favored coal-fired power generation, which is more emitting. And we also saw the industry implements gas to liquid fuel switching in their industrial processes, due to the skyrocketing gas prices. And of course, it's another supportive factor for emissions. On the other hand, for the cement line sectors, metals and chemicals, we saw a quite noticeable decrease in emissions due to both energy savings measures taken and for those more exposed to, let's say, short-term volatility, production curtailment. Regarding the aviation, we were expecting a return to normal activity and actually occurred. You can see that now emissions are back to nearly 50 million tons per year, which is close to what we were a few years ago, so no surprise there. And perhaps this is the most important message to take from this publication. We expect the MSR to withdraw 291 million tons from the auction volumes from September 23 to August 2024, which is about 60 million tons less than last year. So of course, it's kind of a pressure for carbon prices because it means that the market will be less tight this year than it was in 2022.
Etienne, sorry to
Yes.
interrupt, we are a bit late. If you can move on to your conclusion, please.
I'm nearly finished, of course. Sorry for that. So for our outlook, currently the carbon market, as I said before, is driven mainly by very short-term factors. You can see on the news that several market participants are calling it a dead market, and it's not very wrong. Basically, it's all noise. Due to the end of winter and compliance cycle, the emitters are not interested to buy right now at such level of prices. Due to the fragile macroeconomic situation, speculators are no longer interested in investing for now. So all that is strongly reducing the liquidity of the market. And unfortunately, it strengthens its volatility, with only a few million tons exchange being able to move prices by a few euros. But on the fundamental side, we still have bearish signals. So the demand continues to be curtailed by the energy crisis. We have seen some coal to gas switching already materialize, which is bearish for emissions. And of course, we have the additional supply from the repower additional volumes and the lower MSR withdrawals. So basically, what you need to have your eye on is financial news. Every news from the banking sector will of course, let's say, trigger sentiment from the financial participants, and it should, as we have seen mid-March, it should move prices one way or the other. And nuclear developments, because it will impact the thermal power demand. And of course, the energy demand recovery, as already said in the first slide. On the long term, it will be quicker. Our view hasn't changed. So the market will be less tight than expected due to the repower EU mainly, and of course, a long-term impact of demand destruction. So from 2023 to 2026, we expect a much slower uptrend in carbon emissions. But on the other hand, from 2027, we expect a much tighter market due to the REPowerEU again, which will have withdrawn from the supply. And of course, the inclusion of shipping emissions, which is a short market, will increase the tightness of the market. And finally, the supply, and you can see in the red curve on the bottom chart, will be nearly exhausted by then. So all of that should push prices significantly up. And that's it for power and carbon prices. Do we still have time for some questions?
Yes, thank you, Etienne, for this presentation. So stay with us. We will keep some questions during the satisfaction survey. So thank you all for your attention. Just would like to mention that the next webinar session will take place in July 2023. So before we close the session, I will launch the traditional satisfaction survey. So please take some seconds to answer. It's very valuable to us to get your feedback. And I will ask you, Etienne, some questions on the power side. So are we able to have a better view on whether winter 23 will be more difficult or not than the one we had in the past months?
It's a good question because actually there were a lot of worries for this winter, and we had an actually quite mild one. So we were very lucky. We had a very poor nuclear availability, but on the other hand, the demand was significantly curbed. So we actually passed winter quite easily and quite luckily. We only had one really strong event with no renewable production and very cold temperatures. But the spike in power spot prices were actually not as high as we were expecting. For next winter, of course, it's hard to say without the remit update from EDF. For now, the gas storages are at quite high level. We still have sustained LNG imports. So on the gas supply side, we still have a pretty comfortable situation. Of course, it will depend on the corrosion issue developments. But basically, for now, we do not expect much risk for next winter. RTE already said it in the past week in its publications that there were no shortage blackout risk for next winter, and the risks are more on the following ones for now. But of course, really, and I can't stress this enough, keep an eye on EDF's update and how the corrosion issue will turn out.
Okay, thank you, Etienne, for your answer. So I will close the satisfaction survey. So thanks to those who took the time to answer. It's now time to close this session. I hope you enjoyed it, and you will find a replay in the slides in the EnergyScan platform. So see you soon on EnergyScan. Goodbye.